Neeraj Gambhir joins us, Group Executive and Treasury Head in Markets, looks at the wholesale business for Axis Bank. Neeraj, good morning. Thank you for joining us. Well, the bond market, or Mr. Bond, is an indicator of historical recessions. And the bond market is telling you that a recession is around the corner.
Too early to say, Nippon. I think we have gone through these technical inversions in the yield curve in the recent past, and markets are very quick to judge that the recession is on the corner. I think we are at some in the US particularly we are in the middle of a rate hiking cycle, and that cycle has some distance to go. Given the difference between where the US target inflation rate is and where the actual inflation rate is, they have a 600 basis points difference. And that can only be closed if there is some softening of the economy that the Fed is able to engineer. And that will happen over the next 12 odd months or so. Whether that will tip US into a recession or not, I think that's a big debate currently. I don't think the answer is there in front of us. The jury is still out. But I do feel that there will be slowdown in the US, certainly. But that slowdown may not deter Fed from doing what it needs to do to get back its credibility, get ahead of the curve, and make sure that the inflation does not become a persistent issue in the US.
There is this huge debate that has Fed lost its credibility. Yes, they have. But just because they've lost credibility does not mean that they will come out all guns blazing, which is that they've gone wrong and they don't want to go wrong again by over-tightening.
Yeah, so I think the definition of over-tightening, can vary from, scenario to scenario. Currently, if I go by what the markets are pricing in, the markets are certainly pricing in a fairly higher terminal, rate of Fed funds, which is, maybe going up to 3.5% or so over the next, I think, 12 to 18 months. There is also this balance sheet tightening that US is doing. I think you need to keep in mind that over the last about 12 odd years, there is a large amount of monetary stimulus that has been put into the economy because the inflation was quite low, the economic growth was feeble, and so the amount of balance sheet expansion and the persistence of the low interest rate regime in the US has now lasted over a decade. I think that's the part that needs to reverse. I'm not sure if it fully reverses. I think some part of it will reverse. We will probably see about $1 trillion worth of shrinkage in the Fed's balance sheet. But that level of quantitative tightening is likely to have its impact on the economy. And like I said before, I think Fed needs to sort of be ahead of the curve. Fed needs to make sure that the inflation does not become a persistent issue in US. It does not get ingrained, and hence the policy will be tighter, and there will be reversal of accommodation.
Good morning. This is Nantara joining in. So just taking forward from what Nikun talked about, the bond markets, the indication, the inversion also that we've seen twice now in the last 3 days. So as we get spooked by recession, how should one also see this consumer price inflation data that's come off? It's come down in May versus April. So the question that a lot of our viewers may also ask is inflation peaking out?
I think too early to say. We have just one data point where the inflation is lower than the previous, inflation print. This was largely expected because there were base effects, at play. But there are certain sort of counterbalancing effects that we need to keep in mind. In India, for example, the pass-through of fuel prices is still not fully done. With crude prices, crude oil trading at about $120, there is still some distance to go. As the oil prices are sort of aligned with the market conditions, as the petroleum prices are aligned with the market conditions, there is likely to be more second round effects on both inflation as well as growth. So I think it's a bit too early right now to say that we've seen the worst of inflation. We are hoping that over a period of time, the inflation rate will actually come closer to the Reserve Bank's target. But I think over the next 2 quarters, we are certainly likely to see average inflation, which is well north of 7%, and that's not expected to change at this point in time.
In fact, the RBI in its own calculations and inflation forecast has penciled in $105 a barrel as far as crude goes. And as you've seen, it's just not budging from $120. Amit Tripathi from Nippon India Mutual Fund also now joining us live right here for this conversation. Good morning. So, Mr. Tripathi, let's begin with the bond yields. We've been hearing about how it's not sustainable. We've been waiting for that jugalbandi between the RBI as well as North Block. Before we go any further, bond yields, the way we've seen, we saw 352 a few days ago as well. We've seen overnight what's happened with the 10-year bond yield in the United States, the inversion twice that's happened in 3 days, indicating what? The ugly R word, recession.
Yeah, good morning. Thanks for having me. Yeah, I guess I think what the markets are worried about is the fact that where central banks are today in their fight in against inflation, they may end up overdoing what they require to do, and that would be required to fill the gap that exists, the wide gap that Neeraj was just alluding to between the current policy rates and the actual trending inflation levels. And that is why the market is worried about a significant slowdown in the economy, leading to this kind of inversion or possibility of inversion that we are talking about.
Well, there is a tweet from Prime Minister's handle. Prime Minister Modi has reviewed the status of human resource and ministries. I think we can go back to markets. Coming to recruit 10 lakh people in mission mode in next 1.5 years. Important that at least on the government side, you know that there is no visible slowdown which they would be talking about. Okay. What I like about that graphic is simple. Nifty is down only 52 points. Now, just remind our viewers what happened to Wall Street last night. A slippery fall, a gut-wrenching fall in crypto, and on top of that, you have a market which in a sense has been resilient. As we walk into trade this morning, and my first reaction was when I looked at my mobile phone, I said, okay, Nasdaq 3% down. We are going to be in bad Tuesday. But thankfully for us, it's turned out to be a day when we've massively outperformed. I really hope if we stay here, because if we stay here, then that for me is going to be a clear indication of HNI buying and DI buying. I'm just marking the markets right now. Let's superimpose it with crude. Let's superimpose it with Dow. Let's superimpose it with Asia. And if you look at all those markets, I think India is doing remarkably well today on an absolute basis. Neeraj, whatever we may discuss today, the trump or what could pour cold water on everything is high oil and high coal. So yes, we may come out, it may not be a recession in the world. Yes, bond yields may not go up in a linear manner, but ultimately when you have to deal with crude at 120 and coal prices at 70% higher from COVID levels, it just means that we will be in for more energy shock as an economy, and which will be difficult for us. Neeraj.
I agree with you. I think this sense of comfort around energy, and I think that's gone. All nations, whether it is in Asia or whether in Europe, will be focused on their long-term energy security. In that context, I think, and given where the geopolitical is currently and how it is likely to evolve, I think energy security is going to be the prime concern for most of the countries. So we need to focus on that. Particularly with regard to crude, I think the story is not yet complete. We are looking at a scenario where China is gradually opening up, and that is likely to increase demand. While for some of the other commodities, it might, or some of the other supply chains, it mean that as China opens up, the supply chain sort of start working, and that hopefully means lesser inflation. But particularly for commodities, that could potentially mean that we see one more round of higher commodity prices. Crude, it's in a very precarious situation. I think there are some commentaries out there which say that if China fully opens up, we could potentially be in $130 to $150 per barrel handle if we do.
Iska audio bahut okay. Now that's the Brent 3-month move for you. Amit, give me a range, and I'm using 10-year paper for reference here. Next 3 months, how high do you think the 10-year paper could go? Worst case scenario, Amit.
Okay, so just to give you a small background here, I think the good news from a market perspective is that broadly speaking, the market and RBI are in good sync in terms of both inflation expectations, broadly speaking, as well as rate hike expectations. Given that kind of a sync that has happened now almost after a gap of 12 months, one would assume that we are not going to see very sharp movements in the Indian bond market from here on. Having said that, this sinking is not the only driver for bond yields near term, and you can have many external factors, including the fact that you were mentioning about US bond markets having sold off, so on and so forth. The fact that oil price and electricity price pass-through is still somewhat incomplete and prices are volatile. So I would, at the risk of going completely wrong, say that another 15 to 25 basis points from here would be levels at which absolute levels as well as potential inflationary print and rate actions would be reasonably priced in by the market. So, if I can add, I think the issue is not about the bond pricing per se at this point. The issue is more about the volatility that investors can see near term.
Okay.
So it's not a question of whether prices are attractive. It's a question of relative volatility over the next 2 to 3 months that one needs to guard against.
Okay. Neeraj, before we wrap, I started the discussion with a grim question and I used the word recession freely. But we all know that boom and bust are part of cycles. The compulsive bull in me wants to look at the bright side. So let's wrap with what is the bright side. Right now everything is going downhill as if there is no tomorrow. So from an economy standpoint, from a market standpoint, Neeraj, based on your understanding of cycles, what is the good news?
I think the bright side is that India is the fastest growing economy in the world currently. And even the next year, where our expected growth rate is going to be somewhere close to 6.5 to 7%. That would still be the fastest growth rate in the world. And I think, barring the crude shock, which I think today our financial system is in a much better position to handle. Our banking system is very well capitalized. It has the right level of, liquidity and the capital which is available to support the growth of the economy. I think we are in a very good position to handle these shocks and manage these shocks. And I do feel that we are well on our path to become $5 trillion economy that the Prime Minister wants us to become. So I am pretty optimistic about it.
Okay, gentlemen, great to have all of you given that perspective on the state of the economy right now. I think as we move on, it's